There are many options around us to invest our hard-earned and extra or surplus money, as one can invest in bonds, gold, stocks, and other assets, but there is another option for investing your money, which is ETF or exchange-traded fund. For a layman, an ETF is a marketable security that, like an index fund, may follow an index, a commodity, a bond, or a basket of assets. In this video, we will go through ETFs and try to share everything you should know about ETFs. Stick to the end so you won't miss anything. An exchange-traded fund, or ETF, is a pooled investment asset that functions similarly to a mutual fund. ETFs often track a specific index, sector, commodity, or other assets, but unlike mutual funds, ETFs can be bought and sold on a stock exchange in the same manner that a conventional stock can. An ETF can track anything from a single commodity's price to a vast and diverse group of commodities. ETFs can even be designed to follow certain investment strategies. ETFs are classified as either passive or actively managed. Passive ETFs seek to imitate the performance of a wider index, such as the S&P 500, or a more specialized focus sector or trend. Gold mining stocks are an example of the latter category. Well, as of January 9, 2023, there are around 34 ETFs that focus on firms engaged in gold mining, omitting inverse, leveraged, and funds with few assets under management. Actively managed ETFs do not normally track an index of securities, but rather rely on portfolio managers to decide which assets to include in the portfolio. These funds have advantages over passive ETFs, but they are more expensive for investors. ETFs are further classified into four types. There are index ETFs that track the S&P 500 or Dow Jones Index. Second, gold ETFs are linked to gold's market price. Third, sectoral or theme ETFs are benchmarked to a portfolio of companies in a certain industry. Finally, there are international ETFs that invest in funds in other countries. These are typically funds sponsored by their parent company, which is situated outside the United States. ETFs were also listed and traded on the stock exchanges like any other stock. There are buyers and sellers, and the price is decided by supply and demand. Every ETF will be granted a unique ISIN number, and you can store these ETFs in your demat account in the same way that you hold other shares and securities. An ETF can hold a large number of equities across multiple industries, or it can be limited to a single industry or sector. Some funds solely sell products in the United States, while some have a global vision. Banking-focused ETFs, for example, would own stocks from different banks all across the industry. Most ETFs in the United States are structured as open-ended funds and are governed by the Investment Company Act of 1940 unless subsequent laws modify their regulatory requirements. The number of investors who can participate in an open-end fund is not limited. What does the money go to the ETF sponsor? When you invest in gold ETFs, the corresponding amount of gold is stored in a gold custodian bank. Among the most renowned gold custodian banks is the Bank of Nova Scotia in Canada. That implies your gold ETFs are fully backed by physical gold in the custodian bank's vaults. E-gold, on the contrary, does not necessitate the use of a vault. When compared to mutual funds, ETFs offer a substantially lower expense ratio. Indian mutual funds have fee ratios ranging from 2.5% to 3%, whereas ETFs have expense ratios of less than 1%. Furthermore, unlike an equity or index fund, ETFs are exchanged like stocks between buyers and sellers. The ANC is not required to issue new units or redeem existing ones. Well, most people prefer ETFs over index funds, as this can be great because of the cost incurred in them. An ETF which tracks a broad range of U.S. companies has an average cost ratio of 0.36%. But that is the norm. For example, Schwab charges only 0.03% for its U.S. broad market ETF. According to Morningstar, the average fee for diversified no-load index mutual funds is 0.4%. Broker-sold index funds with sales commissions are considerably more costly. ETFs are only sometimes the least expensive, but their structure helps to keep expenses low. When you invest in a mutual fund, the manager must purchase securities with your money and keep records, all of which add to the expenditures. ETFs allow you to buy existing shares that have already been formed by an asset manager, also known as an authorized participant. This will help in reducing transaction costs because nobody at the ETF will have to record your order. ETFs can help you diversify your investments. However, 3 disadvantages come with ETFs that you should be aware of. For starters, because this is a market product, it is subject to market changes. While trading begins near the indicative NAV, actual prices may vary depending on market conditions. Second, bid-ask spreads on ETFs may grow, increasing your risk. Finally, there is the danger of tracking inaccuracy, which means that your ETF may not accurately mirror the underlying index. Now, you should ask how to invest in ETFs. Well, you can invest in ETFs with a lot of platforms available to traders. Investing in ETFs has become rather simple. First, you should look for an investment platform. Many online investing platforms, retirement account provider websites, and investing apps such as Robinhood provide ETFs. The majority of these platforms offer commission-free trading, which means you don't have to pay platform costs to purchase or sell ETFs. However, a commission-free purchase or sale does not imply that the ETF provider would also provide free access to their product. Convenience, services, and product variety are some areas where platform services might differentiate themselves from competitors. For instance, smartphone investing apps make it possible to buy ETF shares with the touch of a button. It's possible that this isn't the case for all brokerage houses, which may require paperwork or a more difficult situation from investors. However, several well-known brokerages provide comprehensive educational information to help new investors become acquainted with and research ETFs. Now, how will you look for an ETF? The second and most critical stage in ETF investing is to conduct research. There are numerous ETFs available in the market today. One thing to keep in mind during the research process is that ETFs are not the same as individual products like stocks or bonds. When investing in an ETF, you must analyze the big picture in terms of sector or industry. Dollar cost averaging, or stretching out your transaction fees over time, is an intelligent trading approach for new ETF investors. This is because it smooths out the returns over time and promotes a disciplined rather than chaotic or unpredictable approach to investment. It also assists new investors in learning more about the subtleties of ETF investment. Investors can progress to more complicated tactics such as swing trading and sector rotation as they gain trading experience. Because it would be costly for an investor to buy all of the equities held in an ETF portfolio individually, ETFs provide reduced average costs. Investors just need to perform one transaction to buy and one transaction to sell, resulting in lower broker commissions because investors only make a few trades. Brokers usually charge a fee for each deal. Some brokers even provide no commission trading on select low-cost ETFs, significantly lowering investor costs. Before investing in ETFs, investors must first open and fund a brokerage account. The particular method of funding your brokerage account will be determined by the broker. After filling out your profile, you can look for ETFs and buy and sell them in the same manner you would stocks. Using an ETF screening tool is one of the greatest ways to narrow down your ETF possibilities. Many brokers provide these tools to help customers filter through the thousands of ETF offers. Well, at last, here are some points that you should consider before purchasing ETFs. Number 1. Volume. Comparing trading volume over time allows you to assess the popularity of various funds. The larger the trading volume, the easier it may be to trade that fund. Number 2. One of the most important points to cover is expenses. The smaller the expense ratio, the less your money goes toward administrative fees, while it may be tempting to look for funds with the lowest expense ratios. Number 3. Another point to look at is the holdings. The portfolios of various funds are frequently factored into screener tools, allowing users to compare the holdings of each potential ETF purchase. Number 4. Last but not least, commissions. Many ETFs are commission-free, which means they can be exchanged without incurring any fees to complete the transaction. However, it is worth investigating whether this is the case. Will you now start investing or not? Comment down your experience if you have invested in ETFs. That's it for the day, guys. We hope you learned something new today. If you did, let us know in the comments below. Also, don't forget to subscribe to the channel and click the bell icon. And we'll see you at the next one. Until then, peace.